The key differences between FHA loans and conventional loans come down to credit requirements, down payments, mortgage insurance, and loan flexibility. Here's how they compare. 1. Credit score requirements. Here's a breakdown of credit score requirements for both FHA and conventional loans. FHA loan credit score requirements 580 plus, eligible for 3.5% down payment. 500,579, requires 10% down payment. Below 500, not eligible for FHA financing. More forgiving for lower credit scores. Allows higher debt-to-income ratio, DTI. Popular for first-time homebuyers. Conventional loan credit score requirements. 620 plus right pointing arrow minimum requirement for most lenders. 700 plus right pointing arrow preferred for better interest rates and lower fees. 740 plus right pointing arrow best rates and terms available. Requires a stronger credit profile. Lower monthly costs if PMI is removed. Better for long-term savings and flexibility. If your credit score is below 620, FHA might be your best option. If it's above 700, a conventional loan will save you more in the long run. 2. Down payment. Why does down payment matter? Imagine you're standing at the edge of a new beginning. Your dream home is within reach. But before you can unlock the door and step inside, the lender asks you for a down payment. This initial sum is your investment into the property. It shows lenders you're financially prepared. But how much do you need to put down? That depends on whether you're choosing an FHA loan or a conventional loan. Let's explore both. FHA loan, the low down payment advantage. An FHA loan is backed by the Federal Housing Administration, FHA, meaning the government helps protect lenders against losses. This makes FHA loans more accessible for buyers with lower credit scores or less savings for a down payment. Minimum down payment. 3.5% if your credit score is 580 or higher. You qualify for an FHA loan with just 3.5% down. For example, home price, $300,000. Down payment, 3.5%, $10,500. This means you could buy a $300,000 home with just $10,500 upfront. A huge advantage for first-time buyers or those with limited savings. What if your credit score is below 580? If your score falls between 500,000 and 579, you're still eligible for an FHA loan, but you'll need a higher down payment, 10% instead of 3.5%. For example, home price, $300,000. Down payment, 10%, $30,000. This protects lenders by requiring a larger upfront investment from lower credit borrowers. Extra costs with FHA loans. While the lower down payment sounds great, FHA loans require mortgage insurance premiums, MIP, which include 1. Upfront MIP, 1.75% of the loan amount. 2. Annual MIP, added to your monthly payments. This means that while FHA loans make homeownership more accessible, they cost more over time due to insurance fees. Conventional loan. Down payments based on strategy. A conventional loan, unlike FHA, is not government-backed. Instead, private lenders fund these mortgages, which means stricter requirements but lower overall costs if you qualify for a good rate. Minimum down payment. 3% for first-time buyers if you're a first-time homebuyer. Some lenders allow just 3% down on a conventional loan, similar to FHA. However, private mortgage insurance, PMI, is required. For example, home price, $300,000. Down payment, 3%, $9,000. This means you can qualify for homeownership with less money upfront, but PMI will be added to your monthly mortgage until you reach 20% equity in your home. Standard conventional down payment, 5 to 20% for most buyers. Lenders expect a 5% minimum down payment for conventional loans. and 20% is preferred to avoid PMI. Here's a breakdown. 5% down, right pointing arrow, $15,000, PMI required. 10% down, right pointing arrow, $30,000, PMI required. 20% down, right pointing arrow, $60,000, PMI not required. If you put down 20% or more, you avoid PMI altogether, which lowers monthly costs significantly. Why conventional loans can save you money long-term while FHA loans make homeownership easier upfront. They require MIP for the life of the loan unless refinanced. Conventional loans, on the other hand, allow PMI to drop off once you reach 20% equity, which means long-term savings. Choosing the right loan based on your financial strategy. Choose an FHA loan if you have low credit, below 620, and need an easier qualification. You can't afford 20% down and want a low upfront cost. You plan to refinance later to remove mortgage insurance costs. Choose a conventional loan if you have a strong credit score, 620 plus or preferably 700 plus. You can afford 20% down to reduce overall costs. You want to avoid long-term insurance fees for lower monthly payments. Final thoughts: down payments impact on your future. Your down payment isn't just a number, it's the first step toward financial stability. Whether you opt for FHA with lower upfront costs or conventional for long-term savings, understanding how down payments affect mortgage insurance, interest rates, and monthly payments is critical to making the best choice. 3. Mortgage insurance. Understanding mortgage insurance, FHA versus conventional loans. When buying a home, one cost many borrowers overlook is mortgage insurance, a fee that protects lenders if the borrower defaults. But did you know that FHA loans and conventional loans have very different rules for mortgage insurance? Understanding these differences can save you thousands over time. What is mortgage insurance, and why does it exist? Mortgage insurance protects the lender, not the borrower. It's required when the down payment is below 20%, because lenders see this as a higher risk. The type of mortgage insurance depends on whether you choose an FHA loan or a conventional loan. Mortgage insurance for FHA loans, mandatory and lifetime costs. FHA mortgage insurance includes two fees: upfront mortgage insurance premium, UFMIP, paid at loan closing. 1.75% of the loan amount can be rolled into the mortgage. And second is annual mortgage insurance premium, MIP, paid monthly as part of mortgage payments. Ranges from 0.45% to 1.05% of the loan amount, depending on loan size and term. Required for the life of the loan unless refinanced into a conventional loan. Key downsides of FHA MIP. Unlike conventional loans, MIP never goes away unless you refinance into a conventional loan or pay off the mortgage. This makes FHA loans more expensive over time, even though they have lower down payment requirements. Example cost breakdown: FHA loan. Home price: $300,000. Down payment: 3.5%, $10,500. UFMIP: 1.75%, $5,250. MIP: approximately 0.85% annually, $2,500 per year. Even though FHA loans help many first-time buyers, the insurance costs add up over time. Mortgage insurance for conventional loans, PMI and cost savings. A conventional loan, on the other hand, is not government-backed. Instead, private lenders finance these mortgages based on the borrower's credit score, down payment, and financial history. If you put less than 20% down, you'll need private mortgage insurance, PMI. But here's the big advantage over FHA. PMI can be removed once you reach 20% equity. PMI cost breakdown. PMI rates vary based on credit score, loan type, and down payment. Typical PMI rates range from 0.3% to 1.5% of the loan amount per year. PMI automatically drops off once 20% equity is reached. Example cost breakdown: conventional loan. Home price $300,000. Down payment 5%, $15,000. PMI, assuming 0.75% rate, $1,875 per year. PMI removal after equity reaches 20%. Key benefit of conventional loan PMI. You stop paying PMI once you reach 20% equity, which lowers monthly payments over time. If you put 20% down up front, PMI isn't required at all. FHA versus conventional mortgage insurance, which one is better? FHA loan, more expensive long-term due to mandatory MIP. Conventional loan, PMI can be removed, saving thousands over time. Choose FHA loan if you have low credit, less than 620, and need easier loan approval. You can only afford a small down payment, 3.5%. You plan to refinance later to remove mortgage insurance costs. Choose conventional loan if you have strong credit, 700 plus, to get better rates. You can pay at least 5 to 20% down and want PMI to drop off. You want long-term savings without lifetime insurance costs. Final thoughts: which mortgage insurance saves you more? Choosing between an FHA loan and a conventional loan isn't just about the down payment, it's about how mortgage insurance affects your long-term costs. FHA is great for first-time buyers, but the lifetime MIP adds costs. Conventional loans save money over time, since PMI can be removed. 4. Debt-to-income, DTI, ratio. FHA versus conventional loan. What is DTI ratio? DTI is calculated as DTI is equal to total monthly debt payments divided by gross monthly income, multiply by 100. This includes debts like credit card payments, car loans, student loans, personal loans, existing mortgage, if any. The lower your DTI, the less risky you appear to lenders because you have more financial breathing room. DTI requirements for FHA loan, more flexibility. An FHA loan is designed for borrowers who might have higher debt loads but still want to qualify for homeownership. The maximum allowable DTI for FHA loans is 55%, making it more flexible than conventional loans. Why FHA loans allow higher DTI? Since FHA loans are government-backed, lenders feel more secure offering loans to borrowers with higher debt loads. Example FHA loan scenario. Gross monthly income, $5,000. Total debt payments, $2,500. DTI calculation. 2,500 divided by 5,000, multiply by 100 equals 50% DTI. Since FHA allows up to 55% DTI, this borrower would still qualify. However, there's a trade-off. Higher DTI means higher monthly payments. It could lead to stricter underwriting requirements, such as proving additional income stability. DTI requirements for conventional loan, stricter but lower costs. A conventional loan does not have government backing, which means lenders take more risk. As a result, they prefer borrowers with lower DTI, typically 50% or lower. Example conventional loan scenario. Gross monthly income, $5,000. Total debt payments, $2,500. DTI calculation. 2,500 divided by 5,000 times 100 equals 50% DTI. This is at the maximum limit for conventional loans, meaning lenders may hesitate to approve it. To qualify more easily, borrowers should aim for a DTI below 45% for better mortgage rates. Why conventional loans favor lower DTI? Lower DTI reduces the risk of loan default. Borrowers with low DTI often get better interest rates and loan terms. It helps ensure financial stability for long-term mortgage affordability. FHA versus conventional loan DTI. Which is better for you? Choose FHA loan if you have higher existing debt, student loans, credit cards, etc. You need flexibility with approval despite high DTI. You plan to refinance later into a conventional loan once debt is reduced. Choose conventional loan if you have low debt or can pay off some before applying. You want better interest rates and lower monthly payments. You have strong financial stability and credit. Final verdict: how DTI impacts your mortgage choice. DTI plays a huge role in loan approval. FHA loans allow higher DTI, making them better for borrowers with existing debt. Conventional loans require lower DTI, making them ideal for financially stable borrowers looking for better interest rates and long-term savings. 5. Loan limits. A loan limit is the maximum amount a lender is allowed to finance under a specific mortgage program. Loan limits exist to prevent risky lending practices, ensure borrowers don't take on excessive debt, align loan programs with local real estate markets. Loan limits are set by the government for FHA loans, while conventional loan limits follow guidelines set by Fannie Mae and Freddie Mac. FHA loan limits, lower but vary by location. FHA loans cater to low to moderate income buyers, meaning their loan limits are lower than conventional loans. But here's the catch: FHA loan limits vary by county, based on local housing costs. For 2025, FHA loan limits are categorized into two tiers. Low-cost areas, $498,257, single-family home. High-cost areas, $1,149,825, single-family home. How FHA loan limits work. Limits are set annually based on local median home prices. Higher cost regions, like California or New York, have higher limits. Multi-unit properties, duplexes, triplexes, have higher limits than single-family homes. Example FHA loan scenario. You want to buy a home in a low-cost area, loan limit equals $498,257. If the home price is $530,000, you cannot finance it with a standard FHA loan. You would need to make up the difference in cash or look for another property. Key considerations. FHA loans are ideal for buyers in affordable markets. If you're purchasing in a high-cost city, FHA may not be enough unless you qualify for an exception. Conventional loan limits, more flexibility, higher max amount. Unlike FHA loans, conventional loans don't have government backing, but they still follow loan limits set by Fannie Mae and Freddie Mac. These limits determine whether a mortgage qualifies as a conforming loan, which has standard rates and terms. For 2025, the conventional loan limit for a single-family home is $766,550 for most areas, up to $1,149,825 in high-cost areas. How conventional loan limits work. Any loan above $766,550 is considered a jumbo loan, meaning it has stricter requirements, higher credit score, bigger down payment. Conventional loans are more flexible when buying in high-cost areas. Example conventional loan scenario. You want to buy a home costing $850,000. If you apply for a standard conventional loan, you won't qualify since the limit is $766,550. To finance the home, you would need to apply for a jumbo loan, which requires at least a 10 to 20% down payment and strong credit. Key considerations. Conventional loans offer higher loan limits, making them better for more expensive properties. If your home price exceeds $766,550, you may need a jumbo loan, which comes with stricter financial requirements. FHA versus conventional loan limits. Which one fits your home buying plan? FHA loan limits. Best for buyers in lower cost markets. Loan limits adjust based on county prices. More accessible for low credit or first-time buyers. Less flexibility for high-priced homes. Conventional loan limits. Higher limits, making them better for expensive homes. Available for jumbo loans with stricter qualifications. More competitive mortgage rates for high credit borrowers. Requires better financial standing to qualify. Final verdict: which loan limit works for you? Choose FHA if you're buying in an affordable market below $498,257. You need easier loan qualification. You have low to moderate income and want a smaller down payment. Choose conventional if you need a loan over $766,550 for a more expensive home. You have strong credit and income to qualify for better rates. You're considering a jumbo loan for a high-value property. 6. Interest rates and overall costs. FHA loan interest rates, generally lower. FHA loans usually offer lower interest rates compared to conventional loans. Since they are government-backed, lenders feel more secure offering lower rates. However, lower interest rates don't always mean a cheaper loan due to mandatory mortgage insurance, MIP. Conventional loan interest rates, higher but better terms for strong credit. Conventional loans tend to have slightly higher interest rates, especially for borrowers with lower credit scores, below 700. However, borrowers with excellent credit, 740 plus, typically get lower rates than FHA loans. If you put down 20% or more, you can secure better rates and avoid PMI, lowering long-term costs. Key takeaway: FHA loans offer lower base rates, but higher insurance costs make them more expensive over time. Conventional loans might start at a higher rate, but with good credit and no PMI, they save money over time. Overall loan costs. FHA versus conventional FHA loan costs breakdown. Lower interest rate helps reduce monthly payments. Upfront mortgage insurance premium, UFMIP, 1.75% of loan amount paid at closing. Annual mortgage insurance premium, MIP, 0.45 to 1.05% of loan amount, included in monthly payments. MIP required for life of loan, unless you refinance into a conventional loan. Example: FHA loan cost, assuming 3.5% down payment on $300,000 home loan amount, $289,500, after 3.5% down. Interest rate, 5.25%. FHA rates are lower than conventional. MIP costs, $2,500 per year, until loan is paid off or refinanced. Total cost over 30 years, significantly higher than conventional due to lifetime MIP costs. FHA loans seem cheaper up front, but the long-term costs due to mortgage insurance add up significantly. Conventional loan costs breakdown. Higher interest rate, varies, 5.5% for lower credit, 4.75% for high credit, 740 plus. No upfront mortgage insurance. If you put down 20%, you avoid PMI completely. PMI, if down payment less than 20%, approximately 0.3 to 1.5% annually, but drops once 20% equity is reached. Lower long-term costs, no lifetime mortgage insurance. Example: conventional loan cost. Assuming 5% down payment on $300,000 home loan amount, $285,000, after 5% down. Interest rate, 5.5%, higher than FHA initially. PMI costs, $1,875 per year, drops once equity reaches 20%. Total cost over 30 years, lower than FHA, especially if PMI is removed early. While conventional loans may start with a higher interest rate, they become cheaper long-term due to PMI removal and better loan flexibility. FHA versus conventional, which one saves you more? FHA loan. Best if you have lower credit, below 620, and need easier approval. Need lower upfront costs, 3.5% down. Plan to refinance later into a conventional loan to remove MIP. Conventional loan. Best if you have strong credit, 700 plus, to qualify for better interest rates. Can afford at least 5 to 20% down to reduce PMI costs. Want lower total loan costs over time, especially if PMI is removed. Final verdict: interest rates versus long-term costs. FHA looks cheaper up front due to lower interest rates and low down payments. However, mandatory mortgage insurance costs make FHA loans more expensive over time. Conventional loans start with higher interest rates, but with good credit and a larger down payment, PMI can be removed, leading to huge savings in the long run. 7. Best fit for borrowers. Choosing between a FHA loan and a conventional loan depends on your financial situation, credit profile, and long-term homeownership goals. Let's break down which loan is best for different types of borrowers. 1. Best fit for first-time homebuyers. FHA loan is ideal if you have a low credit score, 580-620. You have limited savings and need a lower down payment, 3.5%. You need easier approval with higher debt-to-income (DTI) ratio allowance. Downside: higher long-term costs due to mandatory mortgage insurance (MIP). Conventional loan is ideal if you have strong credit, 700 plus, and want lower interest rates. You can afford at least 5% down to minimize costs. You plan to stay in the home long-term and want PMI to drop off. Downside: tougher credit and income requirements. 2. Best fit for borrowers with higher debt, DTI. FHA loan is better if you have existing debt, student loans, car loans, credit cards. You need DTI flexibility, up to approximately 55%, to qualify. Conventional loan is better if you have manageable debt with a DTI under approximately 50%. You want better loan terms with lower monthly payments. 3. Best fit for long-term savings. Conventional loan wins if you want to avoid lifetime mortgage insurance, PMI drops off at 20% equity. You have good credit and financial stability, securing better rates. Downside: requires higher credit scores and a larger down payment. FHA loan might work if you plan to refinance later into a conventional loan to remove mortgage insurance. Downside: higher lifetime costs due to permanent MIP. 4. Best fit for buying in expensive areas. FHA loan is limited if the home price exceeds FHA loan limits, $498,257 to $1,149,825. You may need a different loan type for high-priced homes. Conventional loan wins if you need higher loan limits, $766,550 plus. You can qualify for a jumbo loan for high-value properties. Final verdict: which loan should you choose? Choose FHA if you have lower credit and need easier approval. Need low upfront costs and a lower down payment. Have higher debt but still want to qualify. Are buying a home in an affordable market. Choose conventional if you have good credit and want better rates. Can afford 5-20% down to lower costs. Want to avoid lifetime mortgage insurance, PMI drops off at 20% equity. Are buying in a high-cost area and need a larger loan limit.